Archie, I've often heard that there's no such thing as a free lunch.
Is that a fact?
Well, I can think of 4 examples of financial free lunches.
Well, let's grab a bite.
I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way.
Welcome back to the Last Paycheck podcast. We're your hosts, Archie Hoxton and Rob Hoxton. And today we're going to talk about kind of a financial free lunch that you can take advantage of in your retirement years, and some of them even before you retire. So, Rob, when I say free lunch in or financially, what comes to mind for you?
Well, free lunch, anything that has the words free and lunch in them are going to get my attention, right? I don't often get free lunches, so I get a lot of pleasure out of the idea of thinking about a free lunch. And when it has to do with money, of course, it's even better, right? So there are 3 or 4 things that you can do that won't cost you anything in terms of money or risk, that will put money in your pocketbook, in your account, what have you. And so we're just going to talk about a few of those. Right?
Yeah. And these are mostly focused on taxes, right? And these are especially for those who are retired. Some of them apply both to pre-retirement and retirement. But most people, when they think of saving money in taxes before they're retired, I think they think about contributing more to their 401k or to a traditional IRA or to an HSA or 529, using different kinds of accounts to reduce their tax bill. Maybe if they own a business, maybe writing off some business expenses and that kind of thing. But one of the most often overlooked ways to save money on taxes, this sort of free lunch, is in a taxable investment account, and that's tax loss harvesting.
I love this idea of tax loss harvesting, and it's become more and more prevalent, much easier to accomplish through technology. Right. I know that in our practice, any taxable accounts that we manage are getting active tax management, and that is essentially where if you buy an investment and there's a temporary pullback in the value of that investment, you sell it, take the loss, buy a proxy investment immediately, something very similar, so that you're not out of the market. And what you've done is you've banked that loss that can be used against ordinary income in the year in which you take it. It can be used against capital gains in the year in which you take it or in future years. And if you don't use all of it, you can roll it forward into future years. It's really quite an amazing thing. In fact, there's been a ton of research. Your old employer, Vanguard, actually did some research in which they determined that all things being equal, if you have say an S&P 500 type of an investment, direct indexing, so you have the individual investments, and you compare that to the performance of the index itself, and then you add the tax overlay, that can add anywhere from 1% to 3% in additional after-tax returns in any given year.
Right.
That's free lunch. You get extra return after tax without having any additional risk.
Yeah. Yeah, and because all you're doing is just moving from one investment to a very, very similar investment and banking that loss. And under current tax law, like you said, that can be carried forward forever. If you have a really bad market that comes along, like last year or 2020, you can be going through and harvesting these losses, and you could bank quite a few losses. You can offset your ordinary income. I think it's up to $3,000 per year
for married filing jointly.
Right, but there's no limit on offsetting capital gains.
And you can carry it forward as long as you're alive. So you don't want to really die with unused capital losses from prior years, but you can carry them forward indefinitely while you're living.
Right. And so it's a way to really improve the tax efficiency of your portfolio, right? Where you can really avoid a lot of capital gains that you otherwise would pay.
So let's take a scenario like let's say you have a year where you start, and let's say you just have one stock. Mm-hmm. Let's say it's called Acme Explosives, and you bought this stock from Roadrunner Brokerage Company, and that stock is trading at 100, and through the year it dips to 75, and it ends the year at 100 again. You didn't make any money, you didn't lose any money, but if you didn't loss harvest, you wouldn't have banked the $25 loss, which depending upon your tax bracket could be worth $10, $12 to you. Right. So being actively engaged in loss harvesting and actively engaged in tax management can have a huge financial impact to the positive for you.
Right.
And a lot of financial advisors haven't done this in the past, but more and more of them are now. And part of that is because of the proliferation of the technology that makes it easy to do that.
Right.
I know that
and
we
the
are.
research to support it.
And the research to support it, correct.
Right.
So that's one free lunch that we think is pretty amazing.
There are some pitfalls that we should point out to this, and so this is why it often makes sense to use technology or a financial advisor who can implement this effectively. But the IRS has some special rules around it that you should be aware of. They're called wash sale rules. So if you sell, let's say you own this Acme Explosives, you sell it at a loss, and you immediately buy it back. That loss, you can't use that, right? Because it's just so obviously abusing the tax system.
That's a wash transaction.
It's a wash, right? It's a wash. They disallow the loss. You can't use it. But if you, instead of buying Acme Explosives, you buy Warner Brothers or, something similar, right? Then you can use that loss. Now, this 30-day window...
So what you're saying is that you sell Acme Explosives, you stay out of Acme Explosives for at least the 30 days required for the wash rule.
Right.
You don't want to be out of the market, so you buy Warner Brothers.
Right.
Right, so you're in the market. As long as you're out of Acme Explosives for at least 30 days, you can take that loss.
Right. And then you could, after 30 days, sell Warner Brothers and buy Acme Explosives again.
Yeah.
But you've got to respect that 30-day window. And it's also important to note that 30-day window goes into the past and into the future. That's a little more complicated and probably outside of the scope of today, but just be aware of the wash sale rule. It's a common pitfall, and it can just end up, with unintended consequences, not being able to use these losses that you've, harvested. So,
Archie, let's talk about the second course of our free lunch.
Yeah.
Okay. Tell me about qualified charitable distributions and why they're important.
So qualified charitable distributions are, let's say you're someone who likes to give to charity and you want to take advantage of the tax benefits of giving to charity. If you can give directly from your IRA, right? And what this does is, let's say, if you remember, we spoke about this in a recent episode. You've got itemized deductions and you've got the standard deduction. You can only choose one. Charitable giving is generally an itemized deduction. So unless your itemized deductions, potentially medical expenses, mortgage interest, charitable giving, unless it's higher than the already very high standard deduction, makes sense to take the standard deduction. Qualified charitable distributions allow you to both take the standard deduction and reduce that income with those donations directly from a traditional IRA.
Right. Now, this works for people who are subject to required minimum distribution. So they're in their 70s, right?
Right.
Yeah. So they're already retired people.
Right.
Who want to get the benefit, the tax benefit from their charitable contribution, but also need to claim the standard deduction.
Exactly.
Right.
It works out really beautifully because what you end up with is the IRS is going to require that you take money out, period. You've been saving money on taxes all these years.
Used to be once you were 70 and a half, then it's 72, now it's 73,
probably
headed to 75,
eventually.
depending upon your age. But you'll have those required minimum distributions.
Yeah. Everyone who has money that they've put in a traditional IRA or a pre-tax 401k, they're going to have to do this. But you have a choice. You can either take that money out and pay taxes to the IRS, or you can donate that money to charity and you don't have to pay the tax.
So
on that.
what people will often do is they'll take their required minimum distribution for their IRA or their 401k, and then they'll turn around and write a check to their church or to the local CASA or other important charity, and they will have lost the tax benefit of that donation.
Right.
If they're taking a standard deduction. If they do qualified charitable distributions, they give the money directly from their IRA or 401k account directly to the qualified charity.
Right.
They don't actually take control of that money, but it counts as their required minimum distribution.
And
they don't have to recognize the income.
Right. That's the beauty of it. But
Yeah.
you can't take that extra step. You can't take a check to yourself and then write a check to the charity.
Yeah, it's a lot of work, though.
Yeah.
There's a lot of paperwork. And as we sit here and talk about this, if you are a client of Hoxton Planning and Management, I can tell you that Leota in our office is shaking her head because it's a lot of work. She's wonderful. She does it, but it's a lot of work for your advisor.
At
any rate.
A good advisor will do it for you, though, because it's a great benefit.
Oh, yeah, absolutely. Hey, so we've talked about the first course, which is tax loss harvesting. We've talked about the second course of this free lunch, which is qualified charitable distributions. Let's talk about the cheese plate, bunching gifts and deductible expenses. Why don't you talk about that?
Yeah, so this is another great one. So again, going back to the Tax Cuts and Jobs Act of 2017, this changed the standard deduction. It raised it significantly, which meant that most people who maybe used to itemize, it doesn't make sense for anymore. They don't have enough expenses that they can itemize or enough charitable gifts that they can itemize in any given year, so they just take the standard. However, if you took a couple of years or maybe 3 years and combined all of those expenses and charitable gifts that can be itemized for the deduction into 1 year, well, now you might have a much higher total list of itemizable deductions, and it exceeds the standard deduction. So you take it then, and then in the off years you still take the standard deduction. Maybe you do qualified charitable deduction or contributions as well. But it's the idea of taking multiple years worth of itemized deductions and bunching it into 1 year such that it's higher than the standard deduction, and you save a lot in that year. And then you go back to standard for a couple years and so on and so forth. So that's the idea of bunching.
Yeah, and along with that, a great strategy which just occurred to me is you can also bunch up your charitable contributions. If you're not old enough to be doing the qualified charitable distributions, you can bunch them up by saying, let's take highly appreciated stock, let's create a donor advised fund and put the next 5 years worth of donations to our church or whatever the charity is in it now, qualify for itemized deductions, and then we can parse it out of that charitable fund each year. So we can donate it, get the tax benefit of that in 1 year, but then we dribble it out to the charity over the future years. So this is a really great way to bunch as well.
Yeah. That way your charity that you care about, maybe it's a church or something that's special to you, they get consistent gifts that help them to meet their bottom line and manage their own money, but you get the tax benefit the way you need it. So this can be a really great way to coordinate with a charity that you have a close relationship to.
Archie, this free lunch, before we run out of time, wouldn't be complete without dessert.
Right.
So let's talk a little bit about Roth conversions.
Yeah. Roth conversions are, to keep it simple, you're taking money from a traditional IRA, your pre-tax money, and converting it to Roth, which is after-tax money, and it grows tax-free indefinitely. And what you're doing is you're paying taxes in the year that you make the conversion, right? So this can be useful in a lot of ways. one way to look at it, I mean, you can reduce a potentially really large required minimum distribution. Say for years and years, you've been really diligent, you've saved, you've got a big 401k, it's all pre-tax money, and you're going to have a huge required minimum distribution when you turn 73, maybe by that time it's 75. You can start taking doing Roth conversions, and actually what you'll do is you can coordinate with the CPA and make sure you don't bump yourself into a higher tax bracket, but you can take conversions over time. So you're reducing your potential future RMD, you're keeping your tax bill manageable every year, and then you have more that's going to grow tax-free.
Yeah, and the estate planning benefits of Roth conversion are huge as well. I mean, when you think about when your beneficiaries inherit your assets, if they inherit Roth assets, they aren't governed by the same very strict and punitive rules that assets that are inherited within an IRA are.
Right.
Okay, so they'll have a lot more flexibility, a lot more choices. This is probably something we ought to dig into in another episode because there's a lot here.
Yeah.
But I think maybe that would be a good idea.
Yeah.
So you had a 4-course free lunch today. These are all things that you can do. Loss harvesting, qualified charitable distributions, bunching your gifts and deductible expenses, and Roth conversions. That's a full free lunch. They add to your returns. They add to your balance sheet without costing you anything, not any additional risk or anything. So hopefully that's helpful.
Yeah, and that's all for today. So tune back in next time. We've got lots of good episodes coming up. Remember if you have questions about this, leave us a comment, give us a like, subscribe. Share
we'll
with
either
your friends.
answer you directly or we'll take it up as a topic in a future episode.
Yeah, some questions are shared by lots of people and it would be valuable to do an episode for. So let us know. And remember, share. We're on Spotify, Apple Podcasts, anywhere you get your podcasts, Google, YouTube. So thanks for tuning in, and we'll see you next time.
You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.